So let me start by introducing you to the Investment Committee at Navwealth. For those that don't know me, I'm Craig Manning and I'm going to chair the session today. Next to me here is Drew Hickey. Then following on from Drew is Andrew Webb. Then we have Stuart Holman, and then of course we have Brad, who you wouldn't have probably met before, and we thought this was a good opportunity to sort of show the face, so to speak. So what I might just do now, and Alistair, by the way, couldn't make it, so if there's clients there that normally see Alistair, we just couldn't get into this session today, but he's obviously seen it, and if you've got questions, he will be calling you probably next week because he's off on annual leave this week. So let me tell you a bit about Brad. I'll read his bio so that I do it properly. So Brad Matthews has over 30 years experience in the finance industry and is a highly regarded investment strategist. After working in the money and foreign exchange markets in the mid-1980s, Brad held various economist roles at St George Bank. He then moved into executive management positions at St George Bank, including being head of cards and ATMs, the ATM division. You don't want to be head of that anymore. They're getting rid of that. That was a good move to get on that. And this was prior to Brad establishing his own investment consultancy business in 2015. Brad worked in the investment research area at the AMP Group for 12 years, which included roles as head of research and head of investment strategy. And that's how we met Brad all those years ago. For the past 25 years, Brad's been an editor of a newsletter known as Plain English Economics, which is read by secondary students studying economics. Brad's formal qualifications include Bachelor of Commerce with merit with the University of New South Wales, a certificate in financial planning, and a graduate diploma in applied finance and investment. That is a very hard course, that last one. Brad's been working with us for 6 years, and we appointed Brad really because we wanted to make sure our portfolios were really robust and cost effective. And we felt Brad was a great person to help us with that. As you all know, we use Lonsec for our investment research, and I think Brad sort of offers us another overlay to Lonsec. And we think this provides sort of the best outcome for our clients so that we can all feel comfortable around this table that we're putting the best portfolios together for our clients. In terms of advice, I should read this disclaimer. This presentation contains information that is general in nature. It is not specific to any one individual person, and that's why you come to us as clients, where we do tailor the advice to your personal situation. So it's really important that what we talk about today is of general information only, and if you feel that we need to talk about how it applies to you personally, that's something you should do with your Navwealth advisor. So we might start by setting the scene. I mean, you all see the press every night talking about, I always laugh, when the share market falls, they talk about the billions of dollars that falls. When it rises, they talk percentages. It always makes me laugh. It never fails. Goes up by percentages, but down by billions. But we might start with Brad just sort of setting the scene a little bit on what asset classes have been doing over the last while. Brad.
Yeah, thanks, Craig. And look, unfortunately, it's been a pretty brutal time on financial markets, particularly over the last couple of months. Markets generally travelling up okay up until May, and we had a big sell-off in the first 2 weeks of June, and that's really coloured, I guess, the annual numbers that you're now seeing. So on the slide there, we've got the quarterly and annual and 3-year numbers for each of the major asset classes up until the end of June. And you can see, just looking at those annual results, that Australian equities is down 6.5% for the year, but down nearly 12% over the last 3 months. So the sense was that things were recovering still pretty well out of COVID. Then something changed in June, and we had a major sell-off. The Australian market has done better than the global market over the last year. Global equities are on a hedge basis are down 12.5%, so they've taken a bigger hit over that period. And what's been surprising with this particular sell-off is the extent to which the fixed interest assets have also come down. So we've had a big increase in bond yields, and when bond yields go up, the price of bonds fall. So we've had negative returns in the fixed interest asset classes as well. So it's quite unusual to have a big sell-off in equities and also a big sell-off in bonds. It's a unique feature of this current cycle. So what's driven that sell-off? It's essentially bond yields have increased due to rising interest rate expectations. And that's been in response to inflation, which has come through much higher than expected. I think there was a general sense coming out of COVID that inflation would increase, but nobody thought it would increase to the extent that it has. And as a result, that's surprised markets. We've seen the Federal Reserve, in particular in the US, lift those cash rates by more than expected, and there's still more interest rate increases to come. And that's really spooked equity markets, and we've had a significant sell-off there. And as I said, the lift in interest rates has also meant that bond prices have fallen. The price of things like credit securities has fallen as well. So it's been an across-the-board sell-off. The one asset class that we have been very pleased that we've been investing in is infrastructure. It stands out as the only asset class with a positive return for the last 12 months. You can see there at 9.4. So that's about a 20% outperformance compared to equities on a global scale more generally. Very unusual that you'd have that level of disparity. But a couple of things that have worked in infrastructure's favour is one, that its cash flows are linked to inflation generally. So it actually does well from a revenue perspective when inflation increases. But secondly, it tends to be quite defensive. So things like water utilities, like electricity utilities, still generally get their revenue despite a potential downturn in the economy. The one other thing I'll touch on, just on the right-hand side there, the returns by sector on the Australian Stock Exchange, it really highlights the degree of disparity across different sectors. So it hasn't been all one-way traffic in the equity market. And a big feature of the last year has been the information technology sector. Was really the darling for much of the last decade, but it's come crashing down with the rise in interest rates. So we've seen what we call equities that have a growth style, where there's a big reliance on future growth. They tend to get hit harder when interest rates increase because you have to penalise those future cash flows more. So big sell-off in information technology. One of the reasons that the Australian market has tended to have gone better than the global market over the last year is that we've still had a positive contribution from resources. And as you know, resources are a big component of the Australian market, and a particularly strong contribution from energy. Yeah. So part of the reason we've had this surge in inflation is because energy prices around the world have increased. And that's partly related to what's been happening in Ukraine with sanctions against Russia and so on. But that's actually helped the Australian market. So a couple of things have made the sell-off less worse than it would have otherwise been for Australian investors.
That's great. I think that sets the scene well. And I think one of the things that we observed was we went through the COVID period where we saw the initial fall off in equity markets and the huge rebound, which we're all sitting around scratching our heads. How can markets rebound that much when we're all locked up and can't go to work? And then, of course, the real test has been since January, really.
That's right.
That's been the surprise, I think, to all investors around the world. So what we're going to do now is go through some questions, thanks, Brad, that people have sent in prior to today. And we're going to start with one of Drew's clients. Sent you a question. Drew, take it away.
Fine question, Brad. Something that you actually mentioned as you were talking then was one of our clients has emailed in and said, look, US inflation for the month of June was released last week and was expected to rise from 8.6% to 8.8%. It actually rose above that to 9.1%, which is the highest level it's been since November of 1981. What impact do these historically high levels of inflation in the US have on interest rates, and then how will that impact Australia and domestic and international equity markets?
Good question, and it goes to the heart of what's been happening on markets over the last couple of months. So in terms of the relationship between inflation and interest rates, it's probably important to explain that. Generally, investors need to get paid a rate above inflation in order to give to lend money. And for much of the past 5 years, that hasn't been the case. We've had interest rates close to zero, so inflation's actually been above interest rates. So we've had what we call negative real interest rates. And I think central banks have come to a realisation that that's not sustainable. it actually doesn't create an efficient allocation of capital in the economy. It encourages money to go into inflation-linked assets like real estate. Why would you invest in machinery that depreciates over 10 years if you can invest in real estate that goes up by inflation and your cost of funds is less than that? So it creates the wrong signals in an economy. So I think central banks have been keen to lift interest rates above inflation once we got through the COVID emergency. The fact that inflation has surged higher has made that job much more challenging. And central banks are also concerned about the fact that if inflation gets out of control, it's very hard to bring back into control. We had the experience in the 1970s and 80s. So really, the central banks had no option other than to start raising rates probably more aggressively than they would have otherwise in order to try and manage that inflation situation. So undoubtedly, higher inflation means higher interest rates, pretty much always the case. But the speed of the change in interest rates is quite severe at the moment because that inflation has somewhat come out of the blue. In terms of the impact on Australia, it's a little bit more moderate, both in terms of our interest rates have been increasing to the same extent, but also our inflation numbers don't appear to be heading towards that 8 or 9% that we're seeing in parts of Europe and also the US, as mentioned. One of the problems we have in Australia is that we actually have a big delay in the release of our CPI data. So in the US, you get monthly data on a fairly timely basis. We still only have our CPI numbers for the end of the March quarter. So the June quarter numbers come out next week. But looking at the evidence that we've got on the CPI today, we're only a little bit over 5% at the moment. And even those numbers, there's a lot of one-off factors in those numbers. I've got the chart there just breaking down the categories. So you can see transport, obviously, with higher oil prices has been a big contributor to our CPI. Housing costs have gone up because construction was operating at pretty high levels and there's been shortages of supply of a number of materials, which are starting to work themselves out at the moment. We've had one-off changes to education costs with some changes to tertiary fees, and our food supply has been disrupted by floods as well. So even within that 5.1% number, there's a lot of influences there that you would describe as temporary. So I'm reasonably optimistic our inflation is actually a lot less of a problem here, which potentially means we won't need to go through the same magnitude of interest rate increase. But we don't operate in a vacuum. We're influenced by what happens overseas as well.
Fabulous. I think everyone notices it in their groceries. That's what they tell me every single day.
Filling up the bowser.
Yeah, and filling up, yeah. $160 to fill my car up this morning. That's the most I've ever paid. Anyway, so moving on, Stuart, I think you've got a question for us from one of our
this question flows on nicely from the last one. It's a two-pronged question, basically. If inflation continues to rise, will interest rates continue to follow? And then the second part is what impact it will have on bond prices.
Yep. Yeah. Look, as I said, that relationship is positive. So the higher inflation goes, the likelihood is that interest rates will have to move higher. I do think that there will be a level at which, no matter what the inflation rate is, there'll be some sort of cap on interest rates. So what central banks are aiming to do by lifting interest rates to try and slow the economy, slow demand, take some pressure off inflation. But they're not going to completely eradicate economic growth for the next 5 years by doing so. So there will be a point at which they'll say, okay, we've done as much as we can from a monetary policy perspective. We're not at that point yet. There's still capacity for rates to rise further. You can see on the chart there, we are looking at pretty steep increases in cash rates. We're also looking at quite different levels of cash rates in different countries at the moment. So you might be surprised the extent to which the New Zealand cash rates increased up to 2.5%. At the moment, the US is a little bit over 1.5%, and Australia, as I said, is a bit of a laggard, moving up a little bit over 1% now. But ultimately, when you're looking at economies that aren't the US, they ultimately have to follow the global pattern to some degree. Because if we don't raise our interest rates, even though our inflation may not be as big a problem, if we're sitting here with low rates in the US and everywhere else with higher rates, it actually puts downward pressure on our currency. The Australian dollar would fall, and then we'd actually be importing inflation because imports would become more expensive. So that's one thing to keep in mind. The other part of the question was around bonds and the impact of higher interest rates on bonds. Now, this is obviously, as we pointed out earlier, done a lot of damage to portfolios because we generally hold bonds in investment portfolios rather than just holding cash. And the reason we hold bonds in the first place is because generally we get higher returns out of bonds.
Yeah.
And I'm just demonstrating that from the chart on the screen, which goes back before the year 2000. You can see the extent to which if we invested in what we call the Vanguard or indexed bond portfolio, we've done a lot better than investing in cash. And so you generally get a premium in your return to take into account the risks of holding bonds. Now, the risk of holding high quality government bonds, which tend to dominate that index, is that the value does move with interest rates because of the term structure. So the average interest rate term you get when you hold the bond index is around 5.5 years, approaching 6 years. So it's a little bit like holding a 6-year term deposit, but the market values that term deposit every day. So if you invested in a 6-year term deposit a year ago and maybe got 1%, the value of that term deposit would be worth less in a market sense today when you can earn a much higher rate. So you'd be less willing to pay a price for that term deposit. So bonds get traded in the market, and when interest rates go up, they become less valuable. So if you look at the end of that chart, you can see that there has been a correction in the bond price, but still our long-term view is that you will get paid more by taking on bond duration risk by holding bonds than holding cash. And I might just go into a little bit more detail at the risk of confusing the situation more with the next chart. Our view is that it's actually not a bad time now to be holding more bonds. If you had a choice between cash and bonds, the pendulum has swung more towards bonds because you are getting paid more to take that risk. So what I've tried to show there is the value of a 6-year bond over time, with the starting value of that bond is the principal is 100,000, but you invest a little bit over 88,000 at the start, and it grows to 100,000 over time by earning a yield of 2% every year, which could have been the case maybe 6 months ago. Then the chart shows what happens if you get an interest rate increase to 4% in year 3. The value of that bond goes down. But from that point forward, you earn a higher interest rate of 4%. So whilst you've had the capital impact in year 3, in subsequent years, you're getting a higher return. So that's now the real life experience of investors in bond markets today. They've had a big drawdown in capital value. It's actually the biggest capital drawdown we've had in 100 years in bond markets.
Wow.
But the positive of that is from this point forward, those bonds will go back to their principal value, and you'll earn a higher return in the period now to maturity. So that's why we're more optimistic about bonds than just straight cash at the moment.
And I think that gives a good reason for why we've been saying, generally speaking, to not get out of bonds. Right?
That's right.
It's easy to look at last year's return and go, wow, that's dreadful, sell, sell, sell. But as we've often seen, all the advisors here at Navwealth, when you do make those decisions the next year, so often you sit back and go, oh, damn, I shouldn't have sold.
Yeah.
And that's a pretty good example of that, isn't it?
Yeah, and I think in that sense, it's important to point out that bonds still are a defensive asset. The big difference with bonds and equities is with bonds, we know they're going back to their end value. With equities, all the history tells us that they will, but there's no actual contractual obligation for the issuer to actually push it back to their value.
Yeah.
Whereas bonds, they are naturally defensive. You get what they're worth at the end of the day.
Fabulous. That was a good explanation of bonds, because it's not easy explaining the way bonds work. Oh my God. I think when I did my studies, bonds was harder to do the exams and assignments than shares were. That's for sure. Who's next? So Andrew, I think you've got a client question for us.
Yeah, I've got a question really around this war and potential. So, after Russia invaded Ukraine, there's a general fear that if Russia can invade Ukraine, then maybe China can do the same with Taiwan. And what fears is that, what impact have these fears got on the rest of the markets, especially Asian markets? And what else could we be concerned about?
Yeah, it's a really good question, a very topical question, and we have seen just the damage that can be done by a geopolitical event with the invasion of Ukraine. notwithstanding a huge human cost, it's also had a massive economic impact as well. And you're right, there were a lot of fears at the time that potentially that becomes a trigger for some sort of activity around Taiwan and China. There doesn't appear to be much evidence that anything is imminent in that sense. And I think with investing, you always have these unknown political risks, geopolitical risks. And if you didn't invest because of each one of them, you probably would never invest. And to some extent, that's partly why you get paid a higher return ultimately by holding equities, because you're actually putting your money at risk. But if you're doing that in a diversified and professional manner, history shows you actually get rewarded for that. And whilst I describe the overall geopolitical situation as offering higher risk than normal at the moment, I still don't think it's a reason not to invest, providing you're investing in a diversified manner. It's very hard to put a probability on those sorts of events coming through. But I am heartened by, I guess, the lack of evidence that we've had over the last 6 to 9 months that China's about to embark on anything aggressive. They certainly have a lot of domestic issues that they're working through at the moment, which is probably their major priority. The good news on China, though, as the chart shows that the movement in the broader global equity market and movement in the Chinese market, and you can see quite strongly there over the last couple of months, we've actually seen the Chinese market come back quite strongly. So what's been happening there is that they've been gradually sort of working themselves out of this lockdown situation. It is a bit like it's 2 steps forward, 1 step back, but there is a general sense that they are moving out of lockdown. The other positive aspect of China is that they actually don't have a big inflation problem. They've been through quite a severe economic downturn because of their lockdowns, and the authorities there are making some very positive signs around stimulating the economy. They've announced a big infrastructure spending program, and that's started to return confidence to the Chinese equity market, which is looking exceedingly undervalued. So you've seen the speed of that recovery hit over the last couple of months, and I think it's a good example of why you want to be diversified. You don't necessarily want to try and pick these winners. They're very hard to predict. So if you've got a diversified approach, certainly I think China's too big an economy not to have in a portfolio in some form. It's the world's 2nd largest economy. And unless you are absolutely definite about those risks, I think it plays a role in portfolios, and certainly it's helping our portfolio at the moment in terms of that performance over the last couple of months.
Fabulous. Yeah, I'm sure China will be one day the largest economy in the world, no doubt, yeah. One day. Okay, I've got a question, and this is sort of, I like this question because it's very much about what we're seeing every day, all of us on the television. And the question is, as we're all aware, the media sell advertising by getting people to click on headlines that often scare them. Words such as recession or war or market crashes, higher inflation, higher interest rates, etc. If we were to take a medium to longer term approach to our investment strategy, is there any reason to be concerned by any of these headlines? Brad.
Thanks, Craig. Yeah, look, I think to some extent it's almost the same answer as the Chinese question, in that there'll always be headwinds, there'll always be clouds on the horizon from a macroeconomic perspective. At the moment, again, it's probably more uncertain than it is normally because of we don't really know where inflation is going to end up. We don't know where bond yields are going to end up, and when you don't know where long-term bond yields settle, it's very hard to be very confident about the valuation on equity markets. The bond yield or the risk-free rate is really the base from which we value all assets. And when there's uncertainty over that, there's uncertainty over asset valuations. But I think that equity markets have come down a long way, and I think that's appropriate now that they've factored in those risks, and you're getting a discounted valuation as a result. So the question I think that is being asked here is, will the downturn in the economy be worse than is already priced into equity? Yeah. Certainly, we're already pricing in a downturn. And look, I think there's a couple of interesting aspects to this situation that we're faced with at the moment. My sense is that whilst the US may go into recession, and that may lead the rest of the world into a downturn, I think compared to other downturns, it may be relatively painless, and also relatively short term. one of the reasons I think it might be short term is that we're already starting to see those commodity prices or prices start to roll over and come down. So that will take some heat out of the inflation equation. So potentially that will mean that we're getting to that peak in interest rates very quickly compared to other cycles where the increase in rates is much more drawn out and the pain is sort of over a much more elongated period. I think the other unique feature about the current cycle is the strength of labour markets. I mean, we have had our unemployment number announced last week at 3.5%, which is exceedingly low, and our job vacancies is at a record high level, to the extent now where we have one vacancy per person unemployed. So we've never had that situation before. So to be talking about a serious downturn or recession with unemployment starting at 3.5 does seem a little bit at odds. So I'm reasonably hopeful that the strength in the labour market will be a significant factor in mitigating the magnitude of the downturn, which will make the household sector, I think, probably more resilient than it's been in past periods of stress. In terms of the actual impact of rising interest rates on spending, that's probably the key factor. I might just go to the next slide there. There's been a lot of concern over, I guess, households going into a stress situation because those rates are rising. What this chart shows is the interest repayments as a percent of disposable income in the Australian economy. And you can see there, up until the end of March, before we had this rate rise, it was actually the lowest percent for some time. So because interest rates were so low, banks were actually being pretty responsible and conservative in the amounts of money they were lending, even though they seemed high relative to past periods. In terms of the interest obligation on households, it's actually coming off a very low base. So again, I'm quite hopeful that these interest rate increases that we're talking about, whether it's 1.5 to 2.5%, can be reasonably well absorbed by the household sector, so that we're not going to go into a severe downturn, which is positive for company earnings. The other interesting aspect, which I'll touch on as well, about interest rates, and a lot of investors would understand this, is just on the next slide there. We do have a situation now, as the Australian population has aged, more and more of household balance sheets is reflected in interest-bearing assets. Yeah. So there's a lot of investors who actually will be making more money as a result of interest rate increases. So there's a bigger proportion of households now in that position where they actually do better from rising rates. And this does create a bit of a question mark over the effectiveness of monetary policy, because raising interest rates has two effects. It increases borrowing costs, but it also increases interest revenue. And as more and more of your population has become aged, they've got bigger balances. And you can see there for the first time that household deposits are actually above owner-occupied mortgages in terms of value. So it's a bit of a subtle shift there, but also something to think about when looking at the impact of rising interest rates on the real economy. And certainly to date, we haven't seen spending contract. Again, more recent data has been pretty positive. I think the next chart shows consumer spending has been continually increasing over the last 12 months, and the latest data, which is pretty current, has shown another increase. So whilst the confidence indicators suggest people are worried, the actual spending data hasn't shown any traction as yet. And I think you get that sense if you're walking around Sydney cafes and restaurants. Yeah. There's certainly no evidence of downturn in spending there.
No. We'll just now do a few little random questions that have been coming through. I've got some here in front of me. I love this one. This is a tricky one for Brad. This is your crystal ball, Brad. At what level will inflation peak, do you think?
Yeah, look, I think as I said, with the US, and I think the same would go for the UK and parts of Europe where you've had those bigger inflation surges, I think we're getting close to the peak. Look, it may be 1 or 2 months away, but the thing about inflation at 9%, in order for it to stay at that level, you need continually higher and higher prices to keep it at that level. So we are starting to see some of those drivers of inflation, most notably oil prices, copper prices, nickel prices have come off quite sharply. So possibly we're only 1 or 2 months away from that peaking at maybe 9% globally. With the Australian inflation position. As I said, I think there's less upward trajectory there, but potentially we get to 7 as a peak, and then it starts to level off. And from the Reserve Bank's commentary, they're still quite hopeful that we'll get back down to that average of 2.5% over the next 2 to 3 years, which I think is a reasonable expectation.
This next question I think is really interesting because, you know, as Brad talked about, we saw the US share markets outperforming Australia for a number of years in recent times, and I think our client base does have a home bias, like many countries around the world, and many investors have a home bias. So I think we found that you know, we have to work hard with clients to get them to allocate offshore. So this question is interesting. It says, given all the potential turmoil overseas, is it just safer to invest in Australia where we know the risks?
Yeah, good question. Look, I'd probably start by saying we don't know all the risks.
Yeah.
And one of the risks with the Australian market and stock market in particular is that it's quite narrow from a diversification perspective. It's heavily orientated towards banks and resource companies. What we're missing out on in Australia is a large IT sector and a large healthcare sector. And I think when you look at where the productivity growth and all the invention is going to occur over the next decade, a large percentage of that's going to be in IT and health. Yeah. So I'd encourage investors to stay diversified because we don't want to be picking which sectors are going to win.
Yeah.
But I do think the Australian market is probably too concentrated to be the sole part of a portfolio. But look, to some extent, have a great deal of sympathy with the sentiments in that the Australian market's been a great place to invest. Whilst Australia's only 2% of the global index, it's produced a lot of great companies. When you think of the world's biggest mining company, BHP, biggest media company, News Corp, arguably the most profitable banking sector. Qantas is the only airline that always makes money, essentially. So it's a good place to invest, and it deserves a spot in a portfolio much larger than the 2%.
Yeah.
But I think you do still need to have international diversification.
And so getting a bit back on the inflation story again, I mean, one of the things that I find interesting, I don't know if you've got a comment, Brad, on this. This is not a question, just thinking about it. Like, a lot of this inflation's gone crazy because of supply problems. You just can't buy anything. You know, like if you're, no matter what you're doing, you know, for people online, whether you're renovating a house or buying a car, or it doesn't matter what it is, you just can't get the goods because China's been locked down and all the ships are parked out on the ocean. I mean, at some point that will start to resolve itself, I'm imagining, as China starts to open again. Do you think that'll have a big impact to bring our inflation down and therefore stop interest rates rising?
Ultimately, yes. Yeah. So there's a saying, you might have heard it, that the best cure for high oil prices is high oil prices.
Yeah.
Because it encourages oil producers to increase supply, and ultimately there's a supply response, and that's the way commodity markets in particular work. But I think generally it's true for most goods and to a degree a lot of services as well, that you do ultimately get that supply response.
Yeah.
But it does take time, which is why I think the central banks feel as though they're under pressure to try and manage the demand side as well, just to try and take some heat out of the inflation story. So they're not directly addressing the supply issue, but hopefully that resolves itself, and then you accompany that with demand management and bring about inflation control at the end of the day.
Yeah. So we might, as a wrap up, just talk a bit about some of the things we've talked about today, and if anyone wants to chip in with some thoughts on this, I'll go first. The guys have time to have a think. I guess for me, it's yet again, you know, in 30 years I've been doing this, it's still yet another example where you can't predict markets. You know, we got taught that 30 years ago, we get taught that today, and we're constantly reminded of this. Yet what's really hard for investors is they want to try and time the market by getting out of this industry or market and getting into that one and trying to make a winning call. And it's just so difficult now. We live in this global world that we live in. And we saw this very clearly in our client base. We saw this when the pandemic hit. And look, we had some people that predicted the pandemic would happen and were quite clever in reducing their portfolio to equities and really pushed us to do that. But what was interesting is they didn't get back in time. So they did get out in time, actually, but all the people that did get out got back in too late. And then by the time we did the numbers, they would have been better off just riding through it. And I think that's the message that all Navwealth advisors keep reminding our clients, that you just got to ride through these times, and that our portfolios are well designed, well allocated. You know, sometimes you just got to knock at the screen and just get through the volatility. That's sort of what I take out of this. I don't know, you guys, what else you want to add?
Not for me. Absolutely, yeah. Same story we've been talking about for a long time. So.
Yeah. I think it's a hard time now because the 5-year returns are so flat.
Yeah.
You know, it's a long period now that we've really come over the hill, and even the 5-year returns have flattened out. So it's one of those times where you have to sit still and wait for these markets to catch up again, and know that you're doing the right thing.
Yeah, I think with the 5-year observation is correct. And when you look back at that 5 years, it was a period of exceptionally low inflation and exceptionally low interest rates. And ultimately returns will ratchet down because of that. So returns are made up if you've got the risk-free interest rate, and then you get paid a premium to take risk. We're now moving into a period where that risk-free rate is going to be a bit higher. So hopefully that lifts returns over the next decade, because our base risk-free rate's higher. And in some ways, that's a fairer equation for investors, because they're actually getting paid more to take risk, which I think is the one positive coming out of this experience.
Yeah. And also, I think we've got to remember the dividend side of things, the yield side of it as well. See, dividends got squeezed a few years back, but now they seem to have come back well. So yeah, you're getting the capital fluctuations that are happening. Investors in Australia are still getting a reasonable dividend.
Yeah, that's right. Yeah, and particularly when you look at prospective yields now, you've had the sell-off in the market, but when you look at banks and resources in particular, they're still making a lot of money. So resources are generating a huge amount of cash given where commodity prices have been. So those yields, I think, for the immediate period will particularly help.
Yep.
Wonderful. Well, that's now 45 minutes. I can't believe we kept to time on our first ever live NavTalk. So as we talked about earlier, thank you for those that sent questions in. If we didn't answer your question, or you have another one after you sleep tonight, just email your advisor and we will come back to you. But I hope you enjoyed having a look at our investment committee. This is not generally how we run our investment committee, of course. We get research every month, but our committee meets every quarter, and we go through all the portfolios and how markets are performing and what we need to do or make any changes we need to. So it's a pretty robust process that Brad leads us through. So thank you for joining us. It's been really fun, and the recording will be available. And if I could ask you to do the survey, you'll get a survey questionnaire at some point over the next few days. If you could do that, that'd be great, because this is our first one that we've done live. All our other podcasts have just been recordings that are pre-recorded and beautifully edited. This is the unedited version. And a bit daunting when we thought about doing this, but so we'd like to get some feedback from you. And we do hope to run a seminar, a client seminar later on in the year. We sort of kept putting it off a little bit because of COVID, but we're very keen to do something, maybe November or something around that. So stay tuned. So thanks for joining us, and on behalf of all of us here, have a good day.
Thank you.